Good afternoon, everyone. I see that the crowd has thinned out a little bit, so obviously you are all interested in what we're going to talk about right now, which is DEMPE, intangibles. I'm going to introduce a panel, and then we'll go through some introduction. Then we're going to talk about DEMPE in a technical detail, and then we're going to do some case studies. So first off, I'm Margaret Kritzer. I'm based in San Jose, California. I'm a senior advisor with Taxand US. On the panel with me today is Clemens Noteworthy? No. See, this way you get to remember his name. I'm from California. He's Clemens. Clemens is with us from Taxand, Austria. And then we have Henrik Blankenstein from Taxand, Switzerland. He's also a partner there. And then we have Christina Storm from Taxand, Germany. So I have all of that correct. So far, so good. Okay, so could we go to the next slide? Thank you. So today, again, we're going to talk a little bit about an introduction, what DEMPE is. We're going to talk about ownership of intangibles and the return associated with the ownership of intangibles. We're going to talk about preferential treatment or preferential IP regimes and harmful tax practices, and then we're going to talk about the impact of implementing IP structures. And then we're going to do some case studies. And I know you've heard case studies all day, and then we've gone on, and we're going to do our best to keep on track, okay? So introduction, why are we here today? So those of us that remember 1975, that was a long time ago, the component of the market value of the S&P, over 80% of it was hard assets, and 17% was intangibles. In 2015, it's mostly intangibles. So where are the tax authorities going to get their money, right? They're going to get it from intangibles. So that's why it's a big issue. And that's why it's a very difficult issue that everyone's dealing with. Okay? So what is an intangible? Everybody knows that you can't feel it, you can't touch it. It's not a financial instrument, but it's something that has value, and if you were to sell it to a third party, you would expect compensation for it. And today we're going to talk about mostly what the OECD distinguishes between marketing and trade intangibles. One more? Okay, DEMPE. I'm from the US, so they give me the definition of DEMPE because we don't use DEMPE in the US. So it's the development of IP, it's the enhancement of IP, it's the maintenance, protection, and exploration of IP. And I think we're ready for the next slide, which I think is now I'm passing on. Thank you.
Yeah, thank you very much. Margaret, it was actually pushing me very hard on timing. So if I was supposed to give you a technical introduction into DEMPE. Should you not understand what DEMPE is about, it's all about her fault. Well, in order to better understand the final conclusion on DEMPE, I think we need to scrutinize where we come from, yeah. And in particular, the issue which was identified by the OECD when they started with the project on this DEMPE functions was that the OECD perceived that a lot of structures which were in place in the market were primarily based on contractual relationships, yeah. Contractual relationships which were allocating the ownership of IP to companies which obviously were not really performing the functions relating to the creation of the IP, or were not really controlling the risks which were connected to creating an IP. And it was observed that this is a situation which normally does not happen between unrelated parties. So a discussion was going on whether this should influence the allocation of the return which is generated by utilizing an IP. And the final conclusion was that that substance and function should be more highlighted than contractual relationships. So in a nutshell, what the conclusion was is that the legal ownership by itself does not necessarily mean that the legal owner needs to allocate all IP-related return. However, on the other hand, all other parties which are contributing to the development, for example, of an IP, should generate or should be allocated a part of the final return. So this final solution of the OECD was not to split up the ownership of an IP, which could have been a possible solution as well, and was one suggestion in the first discussion drafts, but to keep the ownership in one entity, whereas all other entities which contribute to the development of the IP or which contribute to the control of a function related to development of the IP should be allocated a part of the specific return. This led, of course, to a specific situation that that functions and risks relating to IP are some kind of specific, which are not perceived in normal value chain transactions. So the OECD established a DEMPE-specific function and risk analysis, which I will show you on the next 2 slides to give you a brief overview on what it is about. Before we start with that one crucial thing, the OECD found out that funding and the development of IP itself is supposed not to be a DEMPE-relevant function. So meaning taking the mere funding of an IP may only attribute a very small part of the overall return, depending on whether the party which is funding controls the financial risk. And depending on this, it may be allocated an risk-adjusted rate of return or even a risk-free rate of return, which is somewhat strange if you look on normal market situations where this can happen also between unrelated parties, but this is more or less the presumption behind that. Well, so on the next slide, as mentioned, I briefly guide you through this DEMPE-specific function and risk analysis. And of course, before you start with this analysis, you need to know what you need to analyze. Yeah. So finally, it's about identifying the IP, what it is about, and identifying the risks which are related to this IP. So this is like the initial starting point. In our situation, I took a very simple example of a contract manufacturer who is developing something, and we got a contract in place which shall be the point where you start. So look at the contract and look what's in the contract, how the functions are defined in the contract, how the risk assumption is defined in the contract, and start with the question, who is the legal owner and what are the contractual relationships. However, this is, as mentioned, just the starting point. You need to go further and really analyze the facts of the case in order to scrutinize who is performing what kind of function. So which party performs function, which party is controlling any risks relating to this development. And based on this functional analysis, you need to decide which party is finally taking control over important functions, control over risks related to the development of an IP. So it goes on further that in the step 4, as you have scrutinized the contractual relationships and you have scrutinized the actual facts and circumstances of the case, you need to ask yourself, is the contractual arrangements, are they in line with the conduct of the parties, and does it really fit together? And if it doesn't fit together, as it is in our case, because we got an IP corp that presumably allocate all IP-related return, whereas we got on the other side an R&D corp which is controlling all the functions and controlling the risks related to IP. We need to properly delineate the transaction, and finally it may lead to a potential adjustment which will take away a profit potential of the IP corp and shift part of the profit potential to the R&D corp, so to the one who is controlling the functions and controlling the risks related to the development. Well, I understand that this was quite short, and therefore we decided that we need to go into further details on certain points, and I just want to highlight some aspects of this DEMPE-related function and risk analysis which I think would be worth understanding. First of all, it's it's about the functions, yeah. So a detailed analysis of the performance of the functions, but also of the control of the performance of the functions, because obviously the OECD found out that an IP owner does not necessarily has to perform all the functions in-house. He could also outsource some functions. However, if functions are outsourced, the crucial question relating to the allocation of return is whether the IP owner is controlling the outsourced function. In this respect, the OECD refers to the control over risk concept, which was embedded in chapter 1. And the final conclusion is that if an legal IP owner does not perform function nor control function, he should not be entitled to any return which is related to the function. Yeah? In theory, this is quite logical. I guess in practice, it's quite difficult to find out what are the relevant functions, yeah? And in particular, what kind of profit is to be attributable to a certain function. Yeah? In particular, if you got several functions which need to work together in order to develop a certain IP. The OECD put it quite straightforward and of course also mentioned that the relative contribution to the value of IP needs to be taken into consideration, and therefore suggested to distinguish normal functions from so-called important functions, meaning these are functions which presumably add more relative value to the development of an IP. However, it should be taken into consideration that if such an important function is outsourced by the legal IP owner, any kind of remuneration will need to take a profit element in it. Yeah? So we will probably end up in a profit split situation if such an important function is outsourced to a party which is not the IP owner. Okay, so far on the function, also the risks are really relevant, and the OECD was highlighting typical and certain risks which are normally related to the development or the DEMPE functions. It anyway goes without saying that the determination of the assumption of risk is important because it finally determines which party is allowed to be allocated any profit which is or any returns from assuming the risks, or as we anyway heard in the morning, which party will finally need also to take the downside if some risks materializes, and which have to bear the costs. In this respect, the OECD, like with the DEMPE functions, realized that there is probably an unreasonable allocation of profits related to risks which are just allocated on paper and which deviates from the persons who are really contributing to the control of these risks. And therefore the OECD also suggested, very similar to the DEMPE specific function and risk analysis, a 6-step approach also to find out who is controlling a risk. Yeah? And I don't want to go into very much detail on this 6-step approach because it's fairly similar to the DEMPE specific functional and risk approach. And finally, also starts with the contractual assumption of risk, goes through the effective facts, looks whether the facts are in line with the contractual relationships, properly delineates the transaction, and finally may come to the conclusion that the risk should be allocated to another party than the one to which it is contractually allocated. One point which should be highlighted relating to risk is that risk management does not necessarily be the same as control over risk. Yeah? I tried to break it down in this slide to make clear that control over risk just means that the two first elements. So this is primarily the decision to take on a risk, and secondly, the decision of whether and how to respond to that risk. Yeah? So for example, deciding on the timing of a certain investment, yeah? Or of the nature of a certain development program and so on. Yeah? This is what meant by control over risk. Yeah? These are the core functions for control over risk. And these functions have to be distinguished from the day-to-day risk mitigation function. So meaning that if you already decided to take on a risk, and you need to subsequently control that risk in more or less on a day-to-day basis. Yeah, this is something that's not meaning control over risk, that's just management of risk. Yeah, and this can be outsourced to another party which is not taking or not assuming necessarily the risk that it controls on a day-to-day level. The crucial issue is, of course, how to distinguish the first two points from the third point, yeah, because from my practical experience, it's rather difficult, in particular the second, so the question on whether and how to respond to a certain risk from their operational management of the risk, which sometimes goes pretty much hand in hand. So I'm in time, and on my last slide on this, yeah. As mentioned, this risk mitigation function may be outsourced as well. And as with the outsourcing of DEMPE functions, the OECD also requests in the outsourcing of risk mitigation function that there is a certain level of control of this outsourced function, yeah, which is surprisingly easy to be met from my point of view. Yeah. It came out initially of Chapter 9 of the OECD transfer pricing guidelines and was taken over by Chapter 1 and by this control over risk concept. But it's just plainly about determining what are the objectives, deciding on who should do it, controlling the one who is doing it, and probably from time to time adapting the objectives or terminating the party, the contract with the party who is controlling this risk. So I guess this is rather something that's easy to be done. However, if we conclude on this control over risk, I guess that the crucial thing is that there is a clear emphasis on the actual performance of this control, which definitely requires personnel and which definitely requires persons who have the capacity to control those risks. Yeah, it's therefore often in practice difficult to get the right persons with the right capacity at the place to control the risk, where you would also like to allocate the returns related to the specific risk. In particular, gets difficult as control over risk does definitely not mean that you are just setting a policy environment, that you are just establishing a control framework, or that you are just formalizing the outcome of the decision-making process. So having people coming together, formally deciding on risks to take. This is not enough for performing effective control over the risk. So it can be summarized that, from my perspective, allocating the risk just on paper will not shift any profits naturally, and it really relates on active decision-making on the risk, on the control of risk.
So what I take away from what you've just said is that contracts are less important than the functions and risks. And when the IRS, at least the US Taxing Authority, has been asked about DEMPE, their comments is that it is essentially a good functional risk analysis. So it's maybe more detailed than we've done in the past, but I think that based on your discussion, I think that what I'm looking at is a more detailed function and risk analysis. But as a transfer pricing practitioner, I think we're all used to seeing those. So this is not new, it's just more complex because contracts, again, are not as important as functions and risks. Okay? So now I think we're gonna move into case studies. Is that I think so. Practical examples. So the first one I think is Clemens as well. No, oh, Henrik, sorry.
So this case study is a situation where we have a brand owner in Switzerland. That's company A in Switzerland. Very famous brand, and that brand has been in existence for years. It is effectively so that in each country there's a subsidiary, that is company C in country X, that is effectively asked to exploit that brand in their market. So they have the right to run the business under that brand in the market. However, the brand owner is still very much involved in setting the brand policies, in ensuring that the brand is positioned well and has a certain position in the market, a certain strategy about the way that the brand looks, but also the way that it is positioned in pricing. So the brand owner plays still an important role in this process. And the company that exploits it in the country, so that is company C, that company is responsible for selling the products in their market and increasing sales. And for that company, of course, has to do marketing as well, because they need to ensure that the local retail and the local customers know about that. So a lot of marketing expenditure is spent by the local company as well to ensure that in their market there is an increase of turnover and an increase of profits. So that's the situation, that's broadly the line of the case. Then we go to the next slide. And this is pre-BEPS effectively, when I was involved in the discussion with various tax authorities on how tax authorities would look at this arrangement in the country where the company had its exploitation. And by the way, what I didn't tell you, but you saw it on the slide, there was a royalty charged for the use of the brand into the operating company that exploits. Now, in some countries, the tax authorities came in and said, you know, effectively what we feel is that the market that is done by the local company, by company X, is actually for the benefit of the brand owner. So we feel that you have a royalty in place, but in addition, I have delineated another transaction there because I see a market service arrangement, because effectively I also work as a service provider as being the exploiter for the brand owner. That is the first, let's say, position that often tax authorities took. And the second position that tax authorities took is saying, well, since we are making such an effort in marketing in that local market, we effectively co-own the brand. So Switzerland is effectively only is owning it, but effectively the royalty that you can charge for that is zero because we own it as well. So co-ownership. Now, just on the first point, what does the OC brings us, I think, as a benefit? I think the analytical framework that we just discussed, with actually also Clémence already discussed with the steps, that we have to analyze the IP, that we have to analyze the contractual framework, in this particular case, a royalty agreement, where, in that particular case, the various DEMPE functions were allocated over the various companies. The licensee was responsible for exploitation, and they effectively should carry a certain marketing expenditure, and other marketing expenditure should be carried by the licensor. That was arranged, that was clear. There was a clear functional allocation. In that particular case, what is of course very helpful if you have an analytical framework that you can follow, is in your discussions with the tax authorities, you can prove very easily that you have fulfilled the accurate delineation and that the tax authorities cannot just state that a marketing service agreement is in place. In that sense, I think the analytical framework can help us also to ultimately defend positions. That's the first one. The second one is I think important as well, is the co-ownership of brand. I feel that it is not a correct delineation of a transaction. I feel that's a pricing issue. Because if the tax authorities say that the royalty was zero, then based on the co-ownership of the brand, then we effectively are going to do a DEMPE analysis. And we're going to say, why do you think that you're the co-owner? Well, if you do the DEMPE analysis, then you will find out that effectively most of the functions here that are relevant in a brand situation are performed by the brand owner. So there is no co-ownership. What you can discuss, of course, and that's a pricing issue, is that whether if there's marketing expenditure being incurred by the licensee, whether they have spent too much on it, and whether therefore the royalty should be adjusted. But that's a pricing issue. It's not an issue of co-ownership anymore. I think that we also take away from the DEMPE discussions, that the previous discussions about co-ownership as being both an economic owner is gone. It is now basically a discussion of pricing. I think that's where I would like to leave it. Of course, the pricing in itself is also an interesting issue. Here in this particular case, we used CAP information together with some margin information to try to make a case. But it is, of course, still a very difficult issue to get the pricing right and to defend that to the tax authorities.
Hendrik, in this case, I'm always wondering, when we go through the DEMPE analysis, I said the very first point is that we identify what's the IP that we're gonna analyze, yeah? And in this situation, I'm always wondering, of course, there is of this brand, yeah, which is licensed, but on the other hand, there's a distribution company which presumably has exclusive distribution right on a certain market, yeah? So this is a second IP being in place, yeah, and this second IP is an IP which is primarily owned, due to the contract, by the local company. So in your example, the company C, yeah, and this also requires a certain development, yeah, and in this situation, my assumption would be that the local marketing is some investment or some creation of this IP, yeah? So it's only the local company which is performing the function, which is controlling the risk relating to the function. The only question could just be, is the extent of the contribution still really relating to this exclusive distribution right, or is it in excess of someone of what a third party would have paid, and is it finally just for enhancing the value of the brand, which is always in some relation linked to each other, yeah? Because, I mean...
collateral damage over
right,
license.
yeah.
That's clear that if you're a licensee, you will build up a certain value. And I totally agree with you. Thank you. I totally agree with you that right, that exploitation right, is an intangible on its own. And it can be tangible for the time that the license is in place. And of course, it is clear that a more routine distributor wouldn't have that right. And therefore, if you compare the remuneration that a more routine distributor would have in comparison to this particular functionality, that we would expect the licensee to have a higher margin. How to quantify that exactly, and that is done in another discussion on its own. But I totally agree with you that we have, of course, tried to find comparable marketing expenditure in comparable companies. That is, of course, information that is not always easy to find. But that's indeed, let's say, you're correct in stating that you need to let's say, identify that intangible as well.
I mean, that's the bright line test to which you're referring. You're wondering yourself whether the extent of marketing expenditures is still at arm's length, and as you really, or as you correctly said, it's very difficult to find out what is the exact amount of comparable marketing expenditures. Yeah? So finally, in practical terms, you will always end up with looking at the operating margin of your distribution company, yeah, and assuming that everything which goes above the normal operating margin that you see on the market is to some extent an intangible related return and will have to be shifted to the IP owner of the brand.
Exactly, and on the other hand, also I would look at transactional information on the royalty rate itself. So indeed, we will indeed investigate both sides of the transactions and the margins being made and the pricing. So, and we never, and that is effectively, I think, a lesson learned, that we would never trust or on one methodology to defend a particular case. We would always have 2 or 3 methodologies being calculated to defend a price or to set a price.
Shall we proceed with the next case, which is a case which I provided? It's about a client who is a very successful app developer, and he was recently able to sell the app for 1.5 billion to a Chinese group. So this really worked out well. However, the structure was some kind of risky, as it was a typical pre-PEPS IP structure. Yeah? We had a IP owner. The IP owner was established in a jurisdiction which had a very favorable treatment of the IP income. Yeah? And the company was able to utilize a patent box regime. And as the more or less the whole company was just about an IP, you could imagine that the vast majority of the profit was subject to this preferential IP regime. However, the company was relating on a contract developer, a related party, which was situated in a high tax jurisdiction. So the personal substance in the IP owner company was quite small. However, the initial founders of the IP were in this IP company, and they had a very small management group around them. Yeah? And there were hundreds of persons in the high tax jurisdiction who were developing the IP. So the client needed to scrutinize the whole regime, yeah, and the whole setup, and to find out whether it would still be possible to allocate the IP-related return to the patent box regime. Yeah, and we are not speaking here on any grandfathering and whether the patent box regime meets the nexus approach and so on. So that's a completely different topic. I just concentrate on the DEMPE functions here, yeah, and how it would be possible to adapt such a regime in order to make it BEPS-proof. And this was just ahead of the proposed disposal of the whole business to a third group. Yeah. Finally, what I realized in this project is that DEMPE theoretically is, as I mentioned, a quite logical concept. Yeah, and that I think for everyone it's quite logical and clear that allocating something on paper may not necessarily attribute any profits. Yeah. However, if you look to a company where everything is just about an IP, yeah, so the whole major business is a development of an IP, it turned out that it's extremely difficult to delineate the facts of the case, yeah, and to find out what are the functions, what are the important functions, and what are the economically significant risks, because it was also interrelated to each other. Yeah? And by breaking down the major functions to sub-processes and then to sub-processes, you found out that it's really on a case-by-case basis, that probably one process could be important, it's performed by the IP owner, the second one is performed by the contract manufacturer. The same is true with the risk. Yeah? Sometimes the contract manufacturer, or most of the times the contract manufacturer came just up with new ideas. Yeah? And the IP owner was just saying yes or no to it, yeah, but doing nothing more. So is this control over risk in terms of what's necessary to be allocated the risk? So we found out that it's quite difficult to delineate the facts of the case, and even if you are able to delineate the facts of the case, the question is still what kind of value and of IP return are you going to attribute to those functions or to those control? And if you're just controlling together with someone else, yeah, will you apply a profit split on this very small part of the IP-related return? So we finally, in this project, we were ending up with the conclusion that as it stands, it would be quite difficult to defend that the IP-related return shall still, after BEPS, be allocated to the IP owner. And we said, well, we got just two chances. The first one is that we change the allocation of the return and will allocate much more of the return to the contract researcher. And the other alternative would be to put more personal substance to the legal IP owner, which is normally in practice just impossible. Because in normal companies you have many, like where you do in old economy, you have many of those researchers which are closely linked to the production process. Yeah? These persons are very valuable, and you cannot just tell them that they should reallocate with their whole family to a small island where it's not so nice, but the sun is shining all day long. Yeah? In our case, the lucky situation was that the top management, all of them, got very valuable stock options. So there was a high motivation to transfer their personal residence, and a lot of them were actually finally moved to the residency of the IP owner. So it still worked out finally, and it was fine for our case. But this is not the typical case that you would see. Yeah? And as said, it could be quite complex if you have a lot of functions which are closely related to each other, to find out or to really delineate the process, and then to be able to attribute some return to these processes. And that's the point, or the right point to step in for Christina, because of course there are some techniques which could be used in such complex situations where you got not a plain vanilla case, meaning an IP owner, he's doing everything, controlling everything what's outsourced, controlling the risk, controlling the outsourced risk mitigation functions, but where you got probably not only one, but several functional owners of a certain IP which is developed together. And Christina is introducing a technical model which could help in such a situation.
Yeah, thank you, Clemens. You already got my introduction, so perfect. Yeah, what we learned so far within the last 20 or 30 minutes is that everything relates closely to functions and risks to be associated to the parties involved, and that there will be a very urgent need to go more in detail, to be more comprehensive, and to maybe dig into a more detailed level of analysis when it comes to DEMPE functions. So for transfer pricing practitioners, the question would be how? How shall I do that? And I will introduce you to a possible methodology in order to identify the functions, the processes behind those functions, and the value contributed by those processes. And how should we do that? There is a certain methodology, a business process analysis, which is utilizing an economic concept, which is called RACI, or in some countries it's also called RACI, but it refers to four main functions or responsibilities where a degree of involvement in business processes is identified. And if we think of that we have to allocate different functions with regard to the development, enhancement, maintenance, and protection and exploitation of IP to the parties involved in special cases, then we can also think of different levels of involvement, as we just learned about the two cases before. There has to be a difference between the responsible party who is taking the decisions. Then there is an accountable party, which is financing the whole processes or functions. And there are also parties which are maybe just consulted or even just informed about the processes. So you have to make scales of involvement and respectively contribute different shares of profit out of this level of involvement. So when you go to the next slide, you will see that it seems to be very, very complex, but mainly there are just a few steps to perform in order to that RACI and process analysis. The first the first thing would be to ask what is relevant for the specific process. And now I brought you a practical example which is not directly relating to DEMPE functions, but it can be easily adapted. So our case was a setup of a rather complex production facility with regard to batteries. And we tried to analyze this specific project in order to attribute the right share of the profit derived out of the operation of this production facility. So what did we do? In the first step, we tried to define the main processes which are relevant for the production of batteries. And we ask ourselves the question, are the main steps, maybe milestones to reach in terms of this specific process? So when it comes to DEMPE, we would probably say that the mega processes in that relation would be development, enhancement, maintenance, protection, and you heard it. So this is the first thing which has to be analyzed. And then secondly, you would also raise the question, what is the main value driver, or respectively the main risks to be associated with that whole process? So imagine in that case, with a setup of production, which is rather complex and maybe involves, as you can see, to have special know-how, to have project management skills, and to have testing tools in place, and so everything which is important. But on the other hand, you can also ask the question, what is the main risk, or what are the main key factors for my specific process, and what do I have to identify in terms of being successful by doing that? So that would be the step 2, and you will also try to weigh them. So what is the most important aspect, and then the second most important aspect? So you have like a share of importance. And if you go to the next slide, it will get to a more detailed level. So I said before, the mega processes, the main processes will be maybe 3 to 5. But then you will ask the question, in order to reach the goal for step 1 or mega process 1, what is relevant? So for example, if you're talking about the main process of the product conception as itself, to come to the maybe appearance, how does the battery shall look like and how does it work, you have to make several steps, beginning from the conceptual design and maybe ending to the implementation process. And those sub-processes will enable you to maybe contribute or allocate the value drivers you identified before in more detail to the respective processes. So the main aspect of this analysis is to come to such a detailed level that you are able to allocate the different value drivers or critical factors in your analysis accordingly to the specific processes. Because what we've learned so far is that you have to distinguish between different processes which are maybe not that relevant for the whole value chain, and other processes which are really relevant. So this is the level of detail required in that specific case. And as you can see, the analysis is combining all the relevant value driving factors or risk factors together to one relative value. And therefore, it is possible to weigh every process according to their value contributed. And if you come to the next slide, you have now your weighted processes. So every process you analyzed has a specific percentage value. And as a last exercise, you will try to allocate those weighted processes to the parties involved. And as I said before, you also have to be a little bit more differentiated. We know the classical functional and risk analysis is making the decision either to have the function and be the functional, performing the function, or you are not performing the function. But by using this concept, the functional involvement of the parties is somehow also rated. So there are parties which are heavily involved, being responsible. That means they have the responsibility not only to be in charge of the overall success of the project, but they are also involved on a day-to-day basis. Then we have parties which maybe not involved on a day-to-day basis, but they take the financial accountability. So by using this factors, you try to put a price tag on the involvement, to say in numbers, where the highest involvement gets a higher number than a weak involvement, and therefore you will be able not to just decide on 100% involved and 0% involved. You can decide between, for example, the one entity could be involved like 49% and the other is 51%. So you get a way more precise number, which is also taking into account the degree of involvement. And if you come to the last slide now, you combine all those different analysis steps towards a result at the end, where you can combining the weighted processes with the RACI analysis, and then you have at the end you shall have a total of percentage numbers, and this should accordingly reflect your contribution to the value chain by the parties involved. And therefore, main takeaway, it is as complex as it looks like, but it is a very, very good methodology to show that you did your best efforts in order to probably reflect the involvement of the parties when it comes to complex value chains. And everyone knows with regard to IP, there's no easy solution. You're often run out of options when it comes to transfer pricing classical methods, and therefore should be taken into account with the recent developments that maybe this is also a solution. Thank you.
Thank you, Christina. Okay, so what we've learned is contracts are important, but they're not the be-all, end-all, and that function and risks analysis, you know, those one-pagers that you used to see in reports, if you have intangibles, they probably need to be a little bit more than a one-pager. And there's lots of complexity in the function and risk analysis when it comes to IP. And RACI is a tool that we've used in a couple cases to support the analysis that we've done with regards to IP. At this point, are there any questions? I know we're between you, planes, trains, and automobiles, or maybe the bar, but yes?
Yeah, I think the main difference is that it's maybe more complex to calculate, but it is taken into regard the contribution to the value chain. And I guess that's the main difference when it comes to classical methods. For example, cost-plus methodology, I think, you have the comparability analysis and you take into account that you have a level of comparability, but you don't dig like into that depth in analysis of functions and processes and value contributions. And I think by this development recently that value chains are getting more globalized and getting more complex, you should have another methodology in your pockets to accordingly reflect this complexity. You could also use it as a backup transfer pricing test. Yeah, that's also possible.
This would be support for your function and risk analysis. Because again, a lot of us, when you're trying to draft a report to supply a government, you want to put it in as simple terms as possible. But how do you get to where you're at? This might help explain why you say that an entity has a certain return that's above what the government would expect or below what the government would expect. Because as we all know, and I think we all appreciate, is every government is looking for more and more revenue. Thank you. Any other questions? Planes, trains, and automobiles. Okay. Thank you all very much. And